We have Jake Clopton on. Jake is with Clopton Capital. And if you want to follow along, and there's a ton of information on his website. So head over to cloptoncapital.com. I'll make sure to have that link in the show notes. But we're going to be talking about a little bit of everything here today because Jake has some multifamily experience and some commercial buying experience himself, but he's also a lender and he's here to help us bridge that gap as people are starting to transition from like single family home buying to multifamily and commercial property and everything in between. So I really appreciate your time here today, Jake.
Likewise. Thanks so much for having me on. Appreciate it. Excited.
So I'm always curious, you mentioned that you started, you do have some multifamily and rental properties of your own. What started you on that journey?
Well, I got into, the commercial real estate finance space in like 2009, 10 era. I used to trade like interest rate futures. I'm in Chicago, so I used to, work at a trading firm here. And, I like to invest in things that I understand. Like, for instance, I'm a really bad stock picker, so I don't buy stocks, but I understand real estate. So the first building I bought was in 2014. It was a 20 unit property, a mix of studios, 1 beds and 2 beds in Cicero, Illinois. At the time, there wasn't a lot of people investing in Cicero, but, I did a lot of homework. It was my first property. So I, went and sat outside the building, to watch what was happening, stuff like that. I got really comfortable with the area and we ended up acquiring it. And obviously, if you own property since 2014, it's probably done pretty well since then.
Yeah. Well, it's interesting that you jumped right into multifamily. A lot of people, like I mentioned before we hit record, that's kind of aspirational. They'll start with single family homes and they'll move up to multifamily, but you kind of jumped right in.
Yeah. I've looked at a lot of SFR stuff in the past. It's, it goes along with my theme of wanting to invest in things that I was comfortable with and I really understood. Right. So all day long, I spent looking at P&Ls for multifamily properties, and I did loans for multifamily properties, right? So, one of the things that helped me out was having the right connections to convince lenders to go into this area that they weren't really willing to look at before. So, that's what kind of pushed me in there, just the familiarity of it and the comfort level. Because I'm not an expert, or wasn't at least, in just single family home rentals and that lending side.
So like I said, you are kind of bridging that gap and filling that gap between as people are moving up to these multifamily. Like, what are some of those things that people should expect are going to be the difference when it comes to underwriting these type of properties?
Yeah, I think the biggest difference is commercial, it really is a different industry than just residential, right? It's got a lot of different rules apply to it. It's got a whole different set of lending criteria. And then also managing these types of properties, right? It's a lot different. Just in general, the mechanicals in a multifamily property is 20 units. It's going to be totally different from just a single family home. And I think, a lot of people that are looking to make that jump, really need to understand and prepare themselves for what those differences are. Like on the operational side, just managing that many units alone in one property, that can be, pretty cumbersome for a lot of people. And, for at least, the first deal or so, I like to, tell people to at least kind of line themselves with a property management company so that they can actually at least see the way that it's operated and, and stuff like that. The mechanicals and some of the repair costs, when it comes to a much larger building, I think can kind of be surprising sometimes. So, just really getting a good handle on, the various upkeep and operational side, I think is, first and foremost, what you should really familiarize yourself with. The lending side is, it is much different as well. A lot of the people that I see that I'm kind of helping bridge the gap from just residential to commercial, right, is, I think the biggest, thing that sticks out right away is that commercial loans balloon and most residential ones don't, right? If you're looking at a residential mortgage, a lot of times you'll get like a 30-year fixed, right? And it just doesn't balloon. the vast majority of commercial loans are going to be 5, 7, or 10-year fixed and balloon within those, sometime in that period. Like understanding that and, the different costs involved, I think are, first and foremost, the biggest issues.
Well, since you brought up the balloon, and I suppose that's probably going to be what a lot of our listeners are like, okay, now the balloon aspect, how is that managed at that time when now this big, large sum of money is coming due? Does it typically roll over into a new loan? How does that all look?
Yeah, I mean, the life cycle of most commercial property ownership is actually sometime within those balloon periods. So a lot of people trade in and out of property, stuff like that. So a lot of times, we'll get borrowers that will, do one of three things, right, at balloon. They'll target, a property exit, and to roll into another property. So let's say in a 10-year timeline, they, obviously increase in value, they've got more equity in the deal, and then they sell. And then the typical game plan then is to 1031 exchange into, a larger property. Right. Mm-hmm. And if you don't know what 1031 exchange is, they're tax deferred, exchange vehicles. So you don't pay, capital gains on, the increase in value. Two, what most people do is, a recap, if they're going to continue ownership. So, and that's, take cash out. So let's say you bought a $2 million property 5, 7, 10 years ago, and now it's going to balloon, right? And that value has increased to $4 million. Right. So technically today you can cash out up to 75% of that 4 million. So everything over your previous loan amount can go back to you as cash out proceeds. Those proceeds are actually not taxed either. Right. So all that, increase in value and all those, the tax liability stays within the property until you exit it. So then you can, again, take those cash out proceeds and roll that into a new property, other investments, stuff like that. There's a good arbitrage, you can make between what you're going to pay on your new loan and then what you can make as a return on whatever you can do with that money, right? I mean, I don't say take it to Vegas, right? But normally it's putting it into another property. Or, some people are just more conservative and they go and, maybe approach the same lender to try to just redo the loan or, go to another source to try to stretch out the amortization and not really take cash out and just roll the loan over to a new facility. So there's a couple of different ways you can go. I mean, at the end of the day, these are investments, right? And everybody's investment profile is different. So what's right for one person is not right for the next. So really just going to come down to a personal investment profile, what they're going to end up doing.
Sure. So just a reminder, everybody, head over to cloptoncapital.com for a lot more information and especially regarding some of the details, because we're kind of going into the weeds on a few things here and it can get it's easy to get lost. So his website is a great resource in which to kind of sort some of this out. Jake, this kind of leads me to my next question around what does a person do then in order to get ready to this graduation as they're going into multifamily? How do they get ready to make sure that they qualify for these larger loans? I know you're talking about loans starting essentially at $1 million or more for right. Some of these multifamily properties or commercial properties.
Right. So, as far as getting ready, I think just getting your ducks in a row on the operational side and, really understanding how this property is going to be operated, what you're realistically going to make on this property, because I guarantee you whatever the sales broker has written down is not how it's going to work out in reality, and then just understanding the risk, right, involved in this property, and how you're going to potentially pay for things that come up. I know a lot of people get in a deal and say, oh, well, the roof is 30 years old and, we'll just handle things that come up, but that can be a pretty big cost. So, kind of ensuring that, you're not overreaching and that you do have good reserves to handle unforeseen costs. I think that's one of the most important things is just, make sure you're not overstretching yourself. That's where I see the vast majority of people get into trouble, right? Unforeseen costs, they overstretch themselves to get into it. And then all of a sudden, things just kind of cascade and spiral out of control from there. Another one of the big differences in commercial versus residential lending is, a lot of in residential, you kind of go get pre-approved for a loan. A lot of people try to and then go, find an investment property and hey, this is how much I can afford, right? There's no pre-approval in commercial. So it's a little bit backwards. So, when you're going into the scenario, You really need to, in my timeline personally is get your equity together, find the property, put together the team, the property manager, and then like the different aspects of your operational side, and then go find the financing, right? It's going to be almost impossible for me to size, a loan without a property, right? Because the economics of the commercial loan are all dependent on the economics of the property itself, not really the person behind it, right? So, I mean, those are some things that I think people can kind of understand and use to prepare themselves for the commercial space. Biggest difference is that, in residential, I think most of the credit decision comes from the person down, whereas commercial, it comes from the property up.
Mm-hmm. So, earlier you mentioned don't trust basically what the salesperson might have put on the property. It kind of reminds me, I've said for quite a while, or this might be just my own personal belief, the pro forma that's typically published is pretty much fiction. You kind of got to dive into those numbers. So when you're reviewing this property, you're not taking that pro forma. You're more curious as to how the buyer, the potential buyer how they're going to run the numbers, how they value it, and how it's almost like a business plan. Would that be a fair statement?
It's a great way to put it. And I say this all the time. Real estate's a business, right? Buying a stock with a dividend, that's just an investment. That's not, real estate is a real operating business, even in simpler properties like multifamily, stuff like that, right? I mean, there's a real, expense and revenue management side that needs to come along with these types of investments. And you're absolutely right. Like when I look at a broker pro forma, you gotta really realize that, the real estate brokers, and it's their job, right? They're here to sell properties, and they need to make it look as attractive as possible, right? And and to do that, like if you go on LoopNet, right? A lot of people are going to search by cap rate, and they're going to have a max. So realistically, they want that cap rate to look as attractive as possible to attract the most people. When you're underwriting a property from the credit side, you certainly look at the pro forma in the sales package, but realistically, I kind of just set that aside. And we really need the seller's P&Ls, right? But even more so, what is something that's becoming even more common now is lenders requesting the seller's tax returns, right? Because very often what's in the P&L versus the tax return can maybe be two different things. And, that might be something that would be a good tip for a lot of buyers, because, what's in the tax returns tends to be, a little bit more accurate than maybe just what's on a P&L, because at the end of the day, a P&L is just something that they created, right? And, additionally, there are certain like standard input, costs that you put into expenses, right? So, market management, market vacancy, certain expense levels, and you can kind of back into those, and what I really suggest is that anybody looking to, buy commercial property really does their own pro forma, right? And understand, like, pull the property taxes, right? I guarantee you, and this is just how it is in Chicago, every single broker, sales pro forma I see has last year's property taxes on it. You know what I mean? And I was evaluating a property, I think last year, and the property taxes on it was just an apartment building. Property tax on it like $25,000, and the buyer was making the decision to buy it based on property tax $25,000, and it turned out that it was actually jumping up to 60 the year after he was going to buy it, and that was already locked into the assessor's office. So surprises like that can come out, and that's definitely going to affect your cap rate, right? So, definitely checking into what all of those things are. And most of them are in public records, right? Like, and, sometimes you can find out what the actual water bills were, ask for the actual utility bills, know what the property taxes you're going to be the year after you buy them, and then input those market vacancy and management. That's another underwriting thing that a lot of brokers leave out, when their cap rate calculation. Then I think you'll get a lot closer to what the real return on this building is going to be.
Yeah, no, one of the things, a lesson that I learned actually, and it seems like it goes by state, because I'm actually on a border between Minnesota and North Dakota. And depending on the state, taxes are calculated different. And in North Dakota, for example, just the act of the property changing hands and you buying at an increased value than what that person had bought, that's what drives the value of some of those commercial properties. So just the sale could bite you in the butt down the road.
Sure, absolutely. I mean, yeah, every assessor is a little different. I mean, the one here in Cook County is, we're not going to go there, but you're right. A lot of times, it really is like just the sale alone. And they're just going to say, okay, well, it's just sold for 400 grand versus 200, which we had it valued before. So that's the new value. And now your property taxes are double. So, right. I mean, those are real numbers, right? I mean, that's real money that's going to go out the door in your investment. So you definitely have to pay attention to that type of stuff.
So talk to about the personal, like any kind of what a person would need, whether it's credit history, what money they should have as a down payment, anything that they might need to bring to the table.
Right. So I'm going to talk specifically about habitational properties, like multifamily, stuff like that. If you're somewhere around anywhere from let's say $600,000 as an acquisition price up to 200, right? That range, or excuse me, up to 2 million. That range is gonna, like, when you get over $1 million in loan amount, you're gonna have access to different types of loan facilities than you would in a sub $1 million space. When you're in this, when you're in the loan amount space that's below $1 million, the vast majority of the financing in that space is going to be from local banks and credit unions, right? And I always tell people this: don't go to Bank of America for small loans. Don't go to a large guy. Literally go to like whatever bank you can find that's closest to the property, like a 1-2 branch bank. That's going to be your best lender for small, commercial properties like that. And the down the middle down payment answer is going to be 25, maybe 20%. Depends on who it is. I think probably maybe some credit unions will give you like up to 80% LTV on stuff like that. But yeah, I think 80% of the answers are going to be 25% down payment. So 75% LTV max. And probably, when you're in this sub $1 million loan space, the vast majority of terms are going to be a 5-year fix and a 25-year am, right? That's not a bad deal if you're talking about $600,000. I've got 2 buildings that have loans just like that on them. I've been doing nothing but arranging loans for 14 years, and that's what I ended up with. So I think that's most people are going to end up with. As far as like personal credit for a commercial loan, you really, I mean, the things that you really need to, avoid are any like blemishes, right? I mean, they're not looking for you to completely, carry the property on your own. It's got its own income, right? But what they want to, what they're really going to search into is 2 things. Are there any bad credit history? Do you have bankruptcies, judgments, stuff like that? I mean, the bare minimum credit score that most lenders are going to deal with is like a 650. So make sure. Obviously, it's a loan, it's a credit decision. So make sure when you're going into this stuff that you kind of clean up the credit profile. If you've got collections or stuff like that can pull it down. Additionally, they're going to want to look and again, going back to this concept before of not stretching yourself, right? They're going to want to make sure that you still got some liquidity, some cash in the bank after you buy this property. And the down the middle answer that I usually tell people is, if you have 10% of the loan amount in outside liquidity after you buy the property, that's a great place, right? So, you've got a $600,000 loan you're asking the bank for. If you've got 60 grand outside of the down payment, that's a great place to be. And I think, the vast majority of lenders are going to agree.
So, you mentioned then we talked about it being treated as a business and essentially having running your own pro forma. Do you take into account a track record? Like if somebody has other multifamily properties, they've shown historically that this is their kind of wheelhouse, that they know what they're doing?
So the track record, isn't necessarily going to affect the underwriting, right, of the property itself. We're going to underwrite the property to like whatever the real expenses are. The track record comes more into the decision of whether or not this person is going to operate this property themselves. Do you know what I mean? Like there's a big difference between, hey, this guy's buying a 20-unit apartment building. He owns 10 others and he manages all of them himself. Great. He can manage his property. There's a big difference between that and, hey, this guy owns 2 single family homes. He's now buying a 20-unit apartment building. he's also going to operate it himself. And that might be a big ask, right? I mean, it's not only a much bigger asset. It's also a different type of asset, and it's really going to come down to the fact of whether or not somebody's going to lend against this property with you as the manager. That's why and I really, really would advise people that are getting into that stuff, to at least for the first year, 2 years, have a real professional property manager in there. Pay them the fee, whatever it is. You can learn, everything that they're going to do and really understand the process. If your end goal is to manage it yourself, I would go that direction, right? At least for the first deal minimum. I think it's going to be tough for you to get to prove alone anyways to do the manager, but, just risk wise, that would be the smarter way to go.
Sure. No, that makes a lot of sense. So with all that being said, it sounds like, would it be fair outside of the down payment? I mean, you're trying to come up with 20%, 25% down payment. That's probably going to be the biggest hurdle for people, is to get that piece together. Or is there anything else they should be aware of?
Outside of really keeping their credit clean and having this good business plan of on the operational side, there's not really ultimately that much that a person themselves really needs. I mean, the property is going to be the vast majority of the underwriting. So I think as long as they manage their credit well and they've got, a good amount of outside liquidity and a good business plan in place, I think the deal gets done. I mean, it's real estate at the end of the day. It's not rocket science, right? There's more than enough ways to trip yourself up. But it's just about having those, the right things in place, which is the credit, liquidity, and the operational side.
So is there, let's say a person comes with a property at a great price. I mean, that's one of the specializations that we do, is finding properties at deep discounts. Is the equity there that can be achieved through those type of negotiations? Can it be considered part of that down payment? So
that's a good question. And I do see that pretty often in residential world, right? Ultimately, the answer is really no. The lenders in commercial space, there's a term called cost basis consideration, right? That's going to go into these deals. And, there's also kind of like a valuation consideration of it's worth what somebody will pay for it, right? Let's say, I get this request all the time, right? Hey, I'm buying this property. I've negotiated the purchase price $1.5 million. I have an appraisal that says it's worth 2.5, right? I want 75% of the 2.5. And unfortunately, it's not going to work the way it's going to go is they're going to go off of, and you'll see this in term sheets also. The max valuation is going to be appraised value or purchase price, the lower of the two, right? So we're always going to go off of purchase price for acquisitions. The typical window when cost basis consideration can burn off, and you can, let's say recap, to refinance all that stuff out to the appraised value. It's going to be somewhere around the 2-year mark. That's where the vast majority of commercial lenders are going to completely burn off the cost basis. I quite often recap stuff at about 12 months of ownership. And, we'll get up to like 85, 90% of the person's total cost basis in there. But that's going to be the way that the vast majority of deals are going to go. There is a different consideration for people that are buying and doing value add, meaning like rehabbing it, they're creating value. But if you're just buying a property that's fully stabilized and you're getting a great deal, you got a great deal, right? But it's not going to ultimately affect how much loan dollars they're willing to lend.
Mm-hmm. So it is different if there's a way that the buyer is adding value.
Yes,
that's probably a whole nother episode.
Yeah. I mean, look, there's a whole bunch of value engineering ways to do things, right? I mean, especially on the construction side, there's a lot of, when people are doing construction, there's a lot of step-up land basis plays you can do and all this stuff. But when you're buying something that's a fully baked asset as it is, and you're just getting a good price on it, they're going to use that price that you're paying for it, right? You might have to wait a little while to really realize, all of that, extra value you're creating at closing. But, I think what that really does for a lot of people is, if they are going to bring in investors, it lets them capitalize the equity side, much, much easier.
Sure. So you also mentioned before we hit record something about joint ventures. How does that work for you?
Right. So I do have a lot of experience in the equity side as well. And we do joint venture at like limited partner equity for like really big developments, right? Like minimum check size of $3 million. But I can also kind of speak to like, some of the guys that we kind of shepherd through the process of moving from friends and family equity up to joint venture equity. And we can talk a bit more about like how they use friends and family equity to capitalize, their initial deals. Most of and these are called syndicators, right? Most of the syndicators we deal with kind of just got their start. Everybody starts at the bottom for the most part, right? And, unless they're working for some real estate company. 1, 2 houses, they go up a little bit more, 3 flats, 4 flats, into multifamily. And then then people start seeing what they're doing, right? And they start pulling in investors. When you start pulling in more and more investors, which is what I think most people want to do, you have to, you have to start moving up in asset size pretty quickly. I'll kind of explain why. Most investors you're going to bring in are not going to want to sign recourse on the loans, right? So let's say, you want to buy a 20 unit property and it costs $1 million, right? And you're going to leverage that up to 75%. So you need 250 grand. You put in 50, and then you've got 4 other investors that put in 50, but none of those guys want to sign on recourse. Well, now you only own 50 grand of equity, but you're recourse on the whole thing, right? So maybe that's okay for the first one, but after the second one, you see what I mean? Your liabilities start to quickly outweigh your assets because now you signed on, as recourse for everybody. So once you start doing the investor route, what you have to do is move into larger properties where you can get more sophisticated types of finance, where you can get non-recourse financing. And non-recourse is really just, it's the entire recourse of the loan is based on the property. So there's no personal guarantee attached to it. So what that does is that allows, syndicators who are pulling in investor capital to be able to be the general partner on basically as many properties as they want. And their liabilities won't outweigh their assets, right? Because they're not signing on a loan, they're just getting equity every time. And that's the way, the vast majority of syndicators, they run into that, contingent liability, dilemma very, very quickly. And it's just as soon as you start going that way and pulling in investor equity, you've got to start moving up the chain to get non-recourse financing. So that was, I'd say, is the biggest thing to keep in mind once you start getting investors.
Sure. So, there's obviously a lot to cover here, and you should really rely on Jake's website for some additional information and insight to try to clarify some things. So head over to cloptoncapital.com. Like I said, I'm going to make sure I have those links in the show notes. And I've already went over the time that I promised I was going to try to keep this to, Jake. So with that being said, is there a question you wished I would have asked you here today?
One of the things that I think is really important for, investors to try to look into, and one thing that really helped me out a lot is that there are a lot of maybe local governmental or local utility programs that, will give people discounts and or pay for energy efficiency projects in their own buildings. For instance, we were able to get almost free boilers. We got free insulation and a lot of stuff like that, which saved us enormous amount of money in a couple buildings because I looked into these types of programs, and the vast majority of people don't know they exist. And I definitely think I don't know if they're in every market, but here in Cook County, Chicago, they do. And I think it's worth everybody looking into is those types of programs for energy efficiency because you can save an enormous amount of money.
So, no, that's a great tip. And I'm guilty of that. I'm sure I could take advantage of some things that I'm not.
I can tell you from personal experience, we saved well over $100,000 by looking into it.
Yeah. Wow. That's some big savings. Well, I really appreciate you providing that last bit of, I mean, if everybody waited to the end there, they probably definitely this was definitely worth the time investment just to listen to this episode. So I really appreciate your time, Jake. I hope you'll consider coming back again sometime. Like I said, I have a feeling we could spend a whole half hour just on one of the many categories that we talked about here today.
Yeah, let's do it anytime. I appreciate it.